Welcome to the session. Topic of this session is conceptual issue in cost and benefit assessment. Actually, there are two types of assessment. One is the financial assessment, another is the economic assessment or economic evaluations. And the purpose of the financial assessment is to evaluate the cost and benefit at individual unit, individual firm or a company we can say. And in case of the economic analysis, we assess the cost and benefit at a society level, at a national level, as a country whole, as a state whole. So in that actually we aggregate the output or input of individual units, individual farmers, individual persons or individual company to reach at the at aggregate level, the national level, state level or sector level. So and the purpose of the economic analysis to see the when we implement a project, so how that project will have an impact on the a country's national income, country's national output or country's saving and country's consumption. So here we assess the points keeping in view the requirement of a nation as a whole. And we have a different objectives and we have the different evaluation approaches, and these basically objectives actually they determine the assessment of cost and benefit when we assess the cost and benefit of individual project or as a whole complete country. And actually the identification of cost and benefit is accordingly to the objectives. If we have the objective to increase the output of the farm, so the production, we want to increase the production, so we have to assess the items related to the production. Or if you have objective to reduce the environmental pollution, so here the benefit will be of types of environmental improvement. So basically the objectives define the cost and benefits items of a project assessment. Then we have different types of approaches for the evaluation of the projects. So like with and without project, and before and after project, we compare the cost and benefit with or without project, or before and after project. Then and there are certain items which we call direct payment transfers. So these cost items generally do not included in the economic analysis, they are the part of the financial analysis. So in this session we are going to discuss about the relevance of the objective in the project assessment. Then we will also talk about the we will learn about the approaches of the project evaluation. Then in the last section of this presentation, actually we will talk about the direct transfer payment. So actually the economic analysis is very important to assess whether the project is able to achieve the set objective of agricultural project as a society whole, as a nation as a whole. And here we compare the cost and benefits and determine which among the alternative project have an acceptable return. So actually we have a number of the projects, and based on that different project we assess the cost and benefit, and then we take the decision the best, which is the best project which we can implement in the society, in the nation, in the states. And this project assessment or evaluation is depend upon the objective of the projects, and a different beneficiary of project have different objective from the project. Like if you have a project of increasing the prices to improve the farmers income, but is for the same project actually the consumer, they want the prices should be reasonable for them. So when we assess the project from the consumer point of view, they will give more benefit, they will get more benefit out of the project if they get the product at cheaper price. Or when we see the farmers, they will be more benefited if they get the more more prices per unit of product. So they have different objectives. So this objective actually decides the cost and benefit of the project. And in this session basically there are 3 learning objectives. First is to explain the relevance of objective in cost benefit assessment of the project. Then we will discuss the various approaches of the project and project evaluation. Then identify the direct transfer payment which are not included in the economic analysis. And so let us first start with the relevance of objectives in the cost and benefit assessment. Actually the project objectives determine the cost and benefit associated with it, and anything that increase the objective of the project is a benefit, and that one that reduces the benefit, it is a cost in the project. So here this is the definition we can say of the cost and benefit. Anything which increase the amount of the objective realization out of that project, that is the benefit, and anything which reduce the benefit to the society, we can say that is the cost to the society. And the problem is that each beneficiary of the project has different objective. For example, a farmers may have the objective of either maximizing returns, or they want to increase their lesser time, or they want to give more preference to the taste, and or they want to have a more risk bearing ability. So these are the objective, maybe farmers. There are different types of objective for farmers, we can say. And basically all these objectives should have the consideration, and they have the effect on the farmer's choice of cropping patterns. So if a farmers want more income, he will prefer some cash crop, sugar corn or cotton, or the oil seed or pulses, or his objective is to provide the food or nutritious food to them. He may prefer for the pulses or rices or mix of the vegetables and fruits. So accordingly the objective of the project, the benefit or the cost are different to the different kind of peoples. And so actually this objective basically they are the income generating capacity of the project. So it's depend upon the objective of the persons, the project, or the farmer, the company or firm. And the analyst should basically consider these objectives while assessing the project cost and benefit, and that is the most appropriate for the overall beneficiaries, and then evaluate the change in the incremental income. So which objectives should be considered by the analyst? So actually, so he should consider that objective which are common to maximum number of the people, maximum number of the beneficiary, and based on that objective he should assess the cost and benefit of the project. And for private business firms or for a government corporation, the major objective is to maximize the net income. And both have a number of the other objective also, like example is the public transport system. Actually when the public transport system, they provide services in the late hours or in the less densely populated area, is an added objective because they are providing the services when there is no transport system available, or the area where there is no transport system available, though it reduces their benefit in terms of the income. So because in the new area or in the late hour, there will be less number of the people who are commuting the transport system, so it will reduce their net income, but this is the, we can say, the added objective for them. So a society has the objective of increasing the national income, but will have many other important objectives, such as to increase income distribution, to increase the proportion of savings, to increase the number of productive job and opportunities, to increase the regional integration, to upgrade the general level of education, to improve rural health, to safeguard national security. So we have the limited budget. So actually government want to increase the net incremental income of the society, but they have also objectives like income distribution. The poor people should also get some income in the production activity, or sometimes the government have focus more on the national securities. So sometimes they invest more on the regional integrations to provide the equal development opportunity to all part of the countries. Sometimes they prefer this objective more, but major objective generally when we assess, we have the the assessment objectives, the consideration of this wide array of objective would lead to a selection of a project that would lead to a maximum increase in the income. So, the major focal point of any assessment is the increase in the national income or increase in the income of the particular persons, but they have also other added objectives, different objectives, but maximum preference is given to the increase in the national income or income. And when we do the economic analysis, it does not consider all the objective of the project at a time. Usually the income maximization objective is considered while selecting the project, and the other objective can be taken care later on. And because maximization of the income is the major objective of the national economic policy, and objective of participation in the project could be for different organization or different people, there may be different objectives for participation in particular projects. For like farm, they want to increase their incremental net benefit. For private business firm or public corporation, they want to increase their net income. Or society as a whole, when we talk about the country as a whole, the maximizing the contribution to the national income, that is the value of the all goods and services produced during a particular year. This is the objective. They want to increase the national income, gross domestic product as a nation whole. So, the other objectives like income distribution, the increasing the saving or the defense of the country, we can take care later on, but maximum the priority is given to the the income enhancement in the country. And the recommended project after the evaluation project would be one that not only give the highest income, but also one making significant contribution towards the social objectives. So, if there are two projects are there and they are giving same level of the highest same level of the income, so in that condition we will select the project who will also giving the who is also adding some social contributions, who is also helping in achieving other objectives for society development. So, for example, there are a number of projects that make almost same contribution to increase income. Choice of project will be one that has the most favorable effect on the income distribution, or the project one that creates the most job, provide maximum employment, one that is the most attractive in a disadvantaged regions like in the dry regions. So, that type of project we select. And in the system of economic analysis, basically anything that increase the national is the benefit and anything that decrease the national is the cost. And the objective of change in the national income refers to change in the real income, that is basically change in the physical or tangible characteristics of goods and services. And in economic analysis, it is assumed that finances for a project come from domestic sources, and that all the returns from the project will go to the domestic residents. So, actually this is the assumption that whatever the investment we are making in a project, it is coming from the domestic resources, domestic sources, and whatever returns we are generating from the project, it going to be affected, or it is going to benefit the domestic resident. And therefore, the national income is considered to be like a gross domestic product, not the gross national product. So, actually we want to value in the real physical terms. So, actually we prefer to have the we want to assess the benefit in terms of the gross domestic product when we talk about the society as a whole. Now, we will move to the second part of this presentation. This session is the evaluation approaches. There are two widely used evaluation approaches. One is the with and without the approach, another is the before and after approach. And with and without approach, basically the project analyst identify and evaluate the cost and benefit associated with the proposed project. So, if we are proposing a project, so he will assess or identify the cost and benefit with that proposed project, and then he will compare or she will compare the situation as would be without the project. So, in this condition, basically the difference between the two is the incremental net benefit from the project investment. So, here he will assess the cost and benefit of the project, and then he will also assess the cost and benefit of the project in other area or control area where the project is not going to implement. So, in that situation, what is the depression is the result of the that project. And the second approach is the before and after approach. So, here the project analyst again identify and evaluate the cost and benefit associated with the proposed project and then compare them with the situation as would be before the project. So, there is a one project of 2 years, and after implementing that project, and what will be the cost and benefit that will be estimated, and and before implementing the project, what was the cost and benefit. So, there will be comparison, and then we find the net incremental benefit from the project. So, here in this way this is basically the before and after approach. But here there is a change in the production and even without the projects, in the when we see the production pattern and there is no project at all, even we will find there is an increase in the project production. So such type of effect is generally not it can not be estimated in the before and after approach. There are different examples, we will going to learn about them. So, this approach does not account for such changes, and the production increase without the projects, there is an increase in the project production. So, such estimated benefit to the project investment that is usually on the higher side. When we talk about the difference in the net incremental income. So, in case of the before and after proposal, this approach higher the measure the higher amount of the net incremental income. So, basically a change in the output without the project could be in 3 ways. So, there are 3 reasons. So, that increase the production of the production in the area or in any occupation, even there is no project. So, we will learn about them. The first situation is that there is an increase in the production take place continuously during the life of the project, that is basically gradual increase in the yield. So, when we introduce the high yielding variety, and even without introducing the high yielding variety, there is an increase in the production over the period of time. The reason for that may be different based on the farmers' experience of cultivating crops. The production will increase, and that type of effect is not reflected in the before and after project. Then second is the reason for the increase in the production is that there is a decrease in the production in the absence of the project. For example, soil erosion in the riverside or on a coast. So, if there is no project is there, even you will find some in some area there is a decrease in the production. So, we can say there is a decrease in the incremental net benefit. If there is a canal is there in the coastal area or coast river side, there will be soil erosion, and the soil erosion is there. And if we build the embankment in that river side, so from that actually what will happen, it will reduce this soil erosion. So, it will if we are so we will reduce this soil erosion, there will be a continuous increase. There is no change in the production in that time. So, with the project, we have the project of building the embankment in the coastal belt or riverside. There is no increase in the production, but it will stop the reduction in the production. So, such type of effect cannot be measured through the before and after project. Then third case is an investment to avoid a loss might also lead to an increase in the production, so that the total benefit would arise partly from the loss avoided or partly from the increased production. So, in the example here is that the lining of canal, when we have the canal, it is simply prepared of the soil, and there is no cover. If we cover that canal with the some bricks or some tiles or some any other, maybe some concrete or cement and concrete. So, here in that way there are 2 types of effect. one is it will reduce the negative effect of the canal like salinization or the seepage of the water, or on the other side it will also increase the production by providing the increasing the flow of the water to large areas. So it will increase the production. So such type of effect is not reflected in the this before and after project evaluation approach. Basically there are two approaches, and if there is no change in the output is expected in the project area without the project, then the two approaches would give the same result. So if there is no project and there is no change in the output, so in that condition both the project approach will give the same type of result. So there is no problem in that. But in some projects the prospect of increasing the production without, and this is another condition, in some of the area the increasing the production cannot be possible without new investment. Like in the example is that in the dry area, when we introduce the small irrigation project, then only the production can be increased. So there is a prospectus of increasing production is only when we have the some irrigation development project in that area. So the net incremental value would be attributed solely to the new investment in the pumps or canals, that is in the drought prone area or dryland area which are lacking the assured source of irrigation. So if you provide there is a source of irrigation, there will be automatically increase the production. So that is the basically result of that project and introducing the new project. Then in many of the resettlement project, it is observed that there may be not any improvement in the output without the project. The economic use of resources is only possible with the project, and in this case without project or before project value would be the same. So here if there is no project, there will be no production activity like in resettlement projects. So if there is we introduce some project, then only their productivity or the production will start. So that is whole attributed to the investment on the resettlement project, we can say. So that is a typical type of situation where the production is due to only with the project only. Without project there is no production activity. So the example is the resettlement project. Then now we will come to the third part of this presentation, that is the direct transfer payment. And these are the items which represent the shift in the goods and services from one entity to the society to another entity without affecting the national income. So suppose I have 100 rupees with me, or another person, I am giving that 100 rupees to another person for his use or her use. So there will be no change in the national income. It is simply transferring from one person to another. So these are called as the direct transfer payment, and we should not include this direct transfer payment in the economic analysis. We may include this such payment in the financial analysis. So in agriculture project analysis, 4 kind of direct transfer payments are common, like the taxes and subsidies, loan and debt service. So debt service is basically the payment of the interest and the repayment of the principal, and they are treated differently in the financial and economic analysis. So we are going to learn about that, how these 4 items, the cost items, they are treated in the financial analysis and economic analysis. In financial analysis, basically a tax payment is a cost. So if a farmers or a company is making some payment in terms of taxes, so that is the cost for him. So upon payment of tax by the farmers, his net benefit is reduced because he is making payment to the government in the form of the tax. But payment of tax does not reduce the national income, because here the tax is transferring his income from the farmers to the government. So it is only a transfer of his income to the government. So as a whole, as a society, there is no change in the income. So since the tax payment does not reduce the national income, it is not a cost from the standpoint of the society as a whole. In economic analysis, basically the tax payment is not included as a cost in the project account. And taxes basically when we are talking about as a direct transfer payment, the direct tax transfer payment representing a diversion of net benefit to the society. So actually we are just transferring the benefit of that 100 rupees of one person to the another. So there is the total benefit is the same in the society. So charges for goods supplied or services rendered may be called a taxes such as water rates. So if there is one irrigation dam is there, government is charging some money from the farmers, so that charge should be considered as a direct payment or it is a cost to him. So such item would be considered as a cost in the both financial and economic analysis, and the decision of transfer payment or as a payment for goods and services depend on the two factors, whether the payment is a compensation for the goods or services needed to carry out that project. So in case the farmer is using the water of the canal, so that is the and he is making the payment to the government for using that water. So that payment is basically a compensation for the water he is using for his crop irrigation. So in that condition we will say it is a cost in the economic analysis as well as in the financial analysis. And if it is only a transfer to be used for general social purpose, then we will say it is not a cost in the economic analysis. Then subsidy is another direct transfer payment, and basically this is just opposite to the taxes. So in case of the taxes, the farmers, the individual company or firm, they pay to the government. But in case of the subsidy, the government gives some help to the farmers or society. So it is the reverse. So here expenditure is from the government side. So farmer is able to basically, if government is providing the subsidy, the farmer is able to purchase fertilizer at subsidized rate and reduce its cost and thereby increase his personal net benefit. So cost of the fertilizer in the use of the society's real resources remain the same. So here the government is transferring his income, his resource to the farmer. So there is no increase in the societal the income. So subsidy reduce the national income available to the society. So when government is providing the subsidy to the farmers, so it is reducing the available resources to the society only, but that is transferred to the farmers. So in economic analysis we must enter the full cost of fertilizers. So in that condition, if we are taking the economic analysis and financial analysis, the cost of production of one bag of the urea, if it is 500 rupees and but it is available to the farmers at 400 rupees, so 400 rupees will be treated in the financial analysis and 500 rupees will be treated in the economic analysis. So there are two forms of the subsidy. One is the lower the selling price of the input or increase the amount, or another is the increase the amount the farmers receive from sale, like providing the minimum support prices to the farmer. Then credit is another the example of the direct transfer payment. It is another major form of the direct transfer payment in agriculture project. And for farmers, the receipt of the loan increase the production resources availability, payment of interest and the repayment of principal reduce their resources. So if farmers receive some loan from the bank, increase his production resources, and when he make the payment in the form of interest and principal repayment, so that reduces his resources. But for the standard of the economy, it looks differently, like does the loan reduce the national income available? No, because the bank is giving loan to a particular person, but it is not affecting this national income as a whole. So there is no change. So it is only a transfer of the control of resources from one person, that is the lender in case of the credit, to the borrower, that is the farmer. So, repayment is also a direct transfer payment. Now, we can conclude the session that we have understand the relevance of the objective in cost and benefit assessment. Actually, the different people, so different section of the society, they have a different objective from the project, and that objective basically help in deciding the cost and benefit assessment of the project. So, actually this project objective determine the cost and benefit associated with it. So, some of the items of that may be the cost for a person, or that may be the benefit for other persons. So, so while considering the objective, that is very important to have the proper evaluation of the project, and generally we take that objective which serve or which cater to the most of the people of the society. And we have also learned that how these cost and benefits are treated in the financial and economic analysis of the project, the various approaches used, the project approaches, that is within, without, and before and after approaches. As understanding is very important of such approaches, which guide us in taking the proper in the evaluation methods, identification of proper evaluation methods based on the project. And then understanding of this concept or methods would basically help in appraisal of the research agricultural project. Then actually we need to have a clear understanding of the objective of the project, and then we should have clear understanding of the evaluation approach of the project. Then we should also have clear understanding on the cost and benefit items. So, which cost and or benefit item should go in the financial analysis, or which cost and benefit item should go in the economic analysis. So, such type of understanding we should have. Thank you very much.